The lifting of pandemic restrictions, quantitative easing, and national policies favoring economic rebound. Any of these can be great news for a marketplace, but when combined, they can be even more powerful. With these benefits in mind, the Chinese government hoped that its real estate market would quickly rebound. Bank loans were also eased to encourage people to buy housing. How could the housing market in China not prosper? However, the situation is the opposite of what was expected. Numerous homes have been listed for sale, but there are few buyers. Currently, the largest wave of sell-offs in history is occurring, spanning from major cities to smaller ones. The number of listings is 7 to 20 times greater than the number of transactions. People in China are less willing to be mortgage slaves. The old home market in first and second tier cities continues to grow, with an increasing number of listings year on year. Data from February shows that the total number of old home listings across 10 major cities in China was 1.9361 million, up 81.99% from the previous year. Notably, Suzhou and Xiamen both experienced year-on-year growth of more than 100%. In February, transactions of old homes in 16 major Chinese cities decreased by 7.6% year-on-year. These cities are the top cities in China in terms of housing market. If the real estate market were truly rebounding, we would have expected to see strong growth in transactions in those cities. Out of the 4 first-tier cities, Beijing experienced a 4% year-on-year decrease in transaction, while Shenzhen and Shanghai's decreased by 37% and 32% respectively. Only Guangdong's transactions increased with a 16% year-on-year growth. In February, there were 126,000 old homes listed for sale in Beijing. Of those, 20,000 were sold, resulting in a transaction rate of 15%. At present, there are over 170,000 listings for old homes available for purchase in Shanghai. Of these, more than 20,000 have been sold, with a transaction rate of 11%. Interestingly, less than 1,400 of these sales were conducted on the open market. According to statistics, all of these transactions were completed within the inner ring road or between the inner and outer ring roads. Any old homes located beyond the outer ring road are designated as resettlement housing. Local authorities provide this information to prevent developers from selling the same house twice. In February, Shenzhen had over 40,000 properties listed for sale, but only 3,000 were sold, resulting in a transaction rate of 7.5%. With a population of over 20 million, this suggests a slow housing market. The city of Guangzhou is facing a challenging situation. Despite having a population of almost 20 million, there are still over 130,000 old homes awaiting demolition, with only 7,000 having been sold. This results in a transaction ratio of only 5%. According to discussions with local Chinese freelancers in the real estate industry, the notable increase in the number of old homes listed for sale can be attributed to several factors. After pandemic restrictions were lifted last year, many elderly homeowners passed away, and their children chose to sell their parents' homes. In addition, some speculators found themselves in a difficult position, leading them to lose confidence in the Chinese housing market and are now seeking to dispose of their properties. Many properties are listed but not selling. According to a freelance real estate agent in Shanghai, the government's lack of sincerity is the reason for this, despite the reduction in loan interest rates and deposit ratios. In China, agents, banks, and developers cannot determine property prices. Instead, the government has the final say. Currently, the real estate industry is considered a pillar of the national economy, which means that property prices are determined by policy and not the market, and are subject to government control. Therefore, if the government wants to demonstrate its sincerity, why doesn't it lower property prices directly? As per the freelancer's opinion, housing prices are still sky high, leading many young individuals to be apprehensive about buying a house due to worries about being unable to afford monthly payments. The pandemic has led to a decrease in youth income over the past 3 years, causing a notable rise in the number of homes being defaulted. Presently, the country has a total of 3 to 4 million defaulted homes. Due to this situation, individuals are being cautious with their finances. They are waiting for an unpredictable future and are uncertain about the possibility of losing their jobs and income. Looking ahead, the freelancer anticipates that the real estate market in Shanghai will remain slow in March due to the current economic climate. With a high unemployment rate, many individuals are apprehensive about spending money. Furthermore, numerous large orders from overseas have been put on hold, leaving small factories without work and construction sites idle. Based on the speaker's remarks, the number of registered old homes in Shanghai has exceeded 170,000 and is expected to continue to rise. It is plausible that the number of listings may reach 200,000 or even 300,000 as more Chinese individuals come to acknowledge the importance of prioritizing fundamental necessities such as sustenance, hydration, and hygiene in addition to maintaining optimal health. What is the backstory behind the recent uptick in real estate market speculations? Let us take a look back to December of last year, when mainland real estate data was unfavorable and the overall market situation declined significantly. According to data from the China Index Academy, out of 100 cities, 68 saw a decline in new home prices and 80 saw a decline in old home prices. In other words, most major cities in China are currently experiencing a drop in both new and old home prices. This chart displays the month-on-month growth rate of new and old home prices in 100 major cities. In December of last year, both experienced a drop to new lows, with new home prices decreasing by 0.08% and old home prices decreasing by 0.22% compared to the previous month. According to data from the China Real Estate Information Group, the sales of new homes by the top 100 property developers in China decreased by 38% year-on-year in December, compared to a decline of only 25% in November. This indicates a continuous drop in new home sales, making the overall housing data for December very unfavorable. In response, regulatory authorities in China have decided to further stimulate the country's housing market. On January 5, 2023, the China Central Bank, together with the Banking and Insurance Regulatory Commission and other authorities, issued a circular to maintain or further lower housing loan interest rates, especially for cities where housing prices are falling. The question arises, why does the Chinese government feel the need to intervene and save the housing industry? One reason is that the housing sector is directly linked to other sectors, including building materials, energy, and finance. It contributes to over 17% of China's GDP, making it too significant to fail. In addition, the housing industry involves a substantial amount of loans, with the total balance of loans nationwide exceeding 53 trillion yuan as of 2022. This poses a significant risk. If the housing industry experiences issues, it is likely to impact credit and transmit risk to China's banking and financial system. This could have a severe impact on the entire Chinese financial system. The third factor to consider is that a large part of China's local government revenue still depends on land premiums and housing-related income. If the real estate market were to weaken, local governments would lose a significant portion of their revenue sources, which could result in a standstill in grassroots society throughout China. Based on the chart, there has been a significant decrease in local fiscal revenue since May 2020, while local fiscal expenditures have remained stable. To ensure the financial stability and health of local finances, policy relaxation for the housing market should be considered. In modern times, even ordinary citizens have a good understanding of the intentions of the Communist Party. The government's goal is to increase housing prices while still maintaining the ability to exert macro control in the future. This is because the government has the power to issue guidance prices for old homes, although this was discontinued in 2022. If the real estate market gradually recovers, the Chinese government will continue to implement guidance prices. This has resulted in investors lacking confidence in future housing prices and having no motivation to enter the market, except for those seeking to buy a house for self-occupation. Furthermore, China is quietly promoting a socialist system with regard to property ownership. Shared ownership is currently being tested in several cities throughout China. Although it has yet to be widely implemented, it is anticipated that it will slowly expand in the coming years. Properties with shared ownership will receive numerous subsidies and restrictions, rendering them challenging to sell on the market. As a result, it will be difficult for property prices to continue to rise. Why does China need to implement strict control over various sectors, including the housing industry? This is related to China's stage of economic development. Currently, China is in the late stage of a stock economy and the beginning stage of a disastrous economy, where there is no feasibility for economic growth and market risks occur frequently. From the government's perspective, in order to ensure political stability, it is necessary to strengthen control in all aspects and fully return to a planned economy. In the private enterprise sector, many reforms and mixed ownership reforms have gradually turned private enterprises into state-owned enterprises, which is the direction of the entire economy. Therefore, the housing industry cannot be left alone and must also be subject to planning and control. It is expected that after this crisis, around 2025, the entire Chinese economic structure, including the housing industry, will undergo huge adjustments and changes. Land finance and real estate will gradually become less important for stabilizing the economy. In the long term, China's economy may have to shift towards a planned economy model, with the market economy's share becoming smaller and smaller. However, marketization is the driving force for economic development, and without it, China's economy may become increasingly stagnant. After the 2008 financial crisis, China's economic decision-makers chose to focus on land finance instead of continuing market-oriented reforms. This decision has led to today's outcome. By embracing land finance, China missed the opportunity to continue market-oriented reforms and transform itself. The direction of the overall trend today was actually determined many years ago. It can be said that the market is losing relevance and planning is making a comeback. Money talks. The biggest sell-off in history shows that both wealthy billionaires and everyday citizens believe that Chinese real estate is no longer a safe bet for increasing in value. If you don't sell now, your assets may lose all their worth. You have no control over the uncertain future and your assets will not be safe. As for the CCP, more funds are about to flow out and a bigger crisis is on the horizon.